Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're gonna break it into our normal 3 segments. And so in segment 1, we're gonna look at some of the overview. It's a little behind, just given that we did have a big build in the US. We had another sizable one in Europe. So we're gonna talk about what's happening, how is that gonna keep progressing, if it's gonna keep progressing. I will get on a soapbox for a quick minute to talk about ethanol and why the comments around E15 are absurd. But again, I'll try to keep that short and brief. Segment 2, we're going to talk more about where the weakness is in demand, how we think that'll adjust as we come into what will be a fairly sizable uptick, especially as we go into next week. Just with Easter, we have Passover, Easter, and the end of where everything is starting to sit when you start looking at spring break travel. And then in the last segment, we're going to talk more about what is happening with OPEC. What are some of the new numbers that they've come out with? They did put their report out. And then how are things shifting, because the physical market still remains weak, but the middle distillate market still remains white hot. So we really want to talk about some of those interesting dynamics. So just kicking off on the ethanol front. Now, if for those that haven't heard, it's optional. It is not mandated to run E15, which is 15% ethanol. But I think this chart is quite amusing when you look at corn futures and how they're at, just to give you an idea, they're at 2012 levels. So we haven't seen corn prices this high since 2012. And now the comment is to increase ethanol. Now ethanol, the crush, which is how you take corn, you crush it, you create ethanol, that is actually trading at a negative margin. So you wouldn't do it. It's not like you would go out and actively do this. It could be mandated, but it all comes down to, this is food. And yes, you can create ethanol from things that we don't consume. I know that, but just think, if you're creating a product, let's call it sorghum, if you're certain types of corn, that's taking away from food. That's taking away from things that could be wheat or beans or some other types of corn. Something that could go towards feed. Again, that is not the solution that we need when you're looking at gasoline, is to put in more ethanol when we're looking at a global food shortage. And the reason why we bring this up is because now international agencies are saying that we need to do more, and by we, I mean the world, and more specifically likely the developed nations, to solve or address the global food shortage. So I just thought it was amusing when we come out and say that we're going to burn more, food in our fuel tanks. So again, these just things that there are other options. I'm happy to go through them if any politician is watching this and discuss what those options are, because I think that this is something that really needs to be addressed and not go down this route. So now getting back to our normal course, EIA scheduled programming, the total oil and product stocks, you can see kind of where they sit. The deficit narrowed from negative 129.6 to 125.2. The crude side continues to creep higher, and that's something that we expect to continue to move up, based on what we had in the EIA today and in Europe. This is, again, going to continue to go up. Floating storage continuing to grind higher. The deficit narrowed from 55 to negative 49.9. That's going to continue to close that gap. It's the products that continue to be the biggest driver. The deficit widened slightly from 74.6 to 75.3. Again, that's the middle distillate side. The gasoline is ebbs and flows. Now that we're on the other side of some of the pickup for Ramadan, especially when you start looking at Fujairah in Singapore, you're starting to see those builds come back. Europe continues to have big builds. They had a small draw, but again, when you look, that's more because of the exports. They're still at near record levels. The U.S. is fairly in line with where we should be this time of year. So as you create diesel, you naturally create gasoline. So that's going to become a bigger concern, especially as you see gasoline demand and driving just not really coming to where it should be. But again, that's going to keep that total oil products fairly low. Now, when we start looking at what's happening in Urals and what's happening with Europe, so more than half of Russia's crude, Urals in April continue to flow to Europe. The volume was less than normal, obviously, but about 1.8 million tons of Urals were sent to Europe. 57% of the 3.16 tons loaded so far this month from Russia's 3 main western ports, compares with about 85% to Europe in February. So obviously there's that big drop. The question is, can they replace the rest of it? And I think that's something that is going to be discussed, and we're going to have to look at. The short answer is it can be. The long answer is it's expensive to do so. And it's because you have to go further out. You're going to have to go and you're going to increase miles per ton. That could be going to Nigeria. That could be increasing from Saudi Arabia. That could be increasing from the U.S., increasing from Libya, depending on where we are. So again, all of these things are going to continue to add to cost specifically into Europe. Now, when we start looking at land storage, you can see the deficit narrowed from 85.1 to 81.5. West of Suez was a driver of that, from 71.9 to 70.9. West of Suez is going to go up again this week, as we said before. And then east of Suez, we're getting back to 2021 levels when you look at the deficit narrowed from 20.9 to 16.6. And we do expect that to continue to collapse and actually come back above 2021 because there is such a degradation in activity in Asia, and Japan is no different. Now, on the flip side, Japan is going to extend gasoline subsidies for oil refiners into May to continue offsetting the rise in crude prices. So again, they're still trying to protect, but the inflation is there. The crimp on the economy remains as global trade continues to flounder. Now, when we start looking at floating storage, you can see the surplus widened from 21.7 to 28.3. We're below where we were in 2021, but obviously above that 2016 to 2019 range. Floating storage, the west of Suez went from a surplus narrowed from 2.1 to 1.1. We expect that to reverse again and go back up again, but not a huge surge. But again, west of Suez is going to continue to be elevated. And one of the shifts was Europe. So Europe had a decent amount of crude in floating storage. That has gotten pulled on shore. We'll talk about that in segment 3. That's why we did get a big spike in onshore storage. The bigger increase was east of Suez, where the surplus widened from 19.8 to 29.6. So we did get a big increase, and we expect more of that on the east of Suez side, specifically in Asia, because as the cargoes, remember we keep talking about that timing. Once you go into transit, you're going from floating storage or directly from the port in one area to, at this point, floating storage in the other. And that's continuing, especially because you have the lockdowns in China. You have a lot of those issues that continue to play out with refinery run rates still at record lows. So now when we look at crude stocks in the U.S., you can see that we had a build of 9.38 million. We're still 81.6 million below the 5-year average. But when you look at where that is being really created, it remains PADD 2 and now PADD 3. So PADD 2 had a build of 1.81 million. That's still 29.7 below the 5-year. Cushing had a build of 450,000. And remember, we keep talking about how Cushing's going to continue to build. It's just going to be at a much slower pace. It's going to be very gradual. So 450,000 barrels bring us to 23.1 million below the 5-year. PADD 3 had a big spike of 4.86 million, the biggest increase, and that brought the 5-year average to only 22.7 million below. And when you look at the shift, we had a decent drop in refinery run rates by about 2.5%. You had exports going down. A lot of that is timing. So even though we did have imports come down, we did have a big drop in exports, and that drop in exports is the one that's going to kind of waffle back and forth. We do expect imports to remain elevated, and or I should say go back up, and exports to remain fairly strong. Now, when you factor in the aggregate from the SPR, the build was only 5.48 million. So we had about 4 million barrels, just below 4 million barrels, come out of the SPR and again get pushed into the commercial world. Crude oil, the production, as we've been saying, we're a bit closer to 11.9 now. We have us at about 11.87, 11.86 in that range. So we will get to that 11.9 by the time we get into the first week of May. So now when we start looking at runs, this is what we were talking about with the drop of 2.5%. You can see the runs went from 92.5% to 90. The biggest driver was Pad 5. So for those that didn't see it, there was a fire at one of the key ports. And again, that shut a lot of things down from the Chevron side. And then we also had some decently sized turnarounds in Pad 5, accounting for that big drop. That's something that it'll take about another week or two based on what we're seeing start to come back. But really Pad 5, Pad 2, or if you remember, we said that Pad 2 was going to start to come down a bit just because they are elevated. They're still above the 5-year average. So Pad 2 still has a bit more to go. Pad 3, fairly stable. We expect that to be the case. And then Pad 5 coming back will bring us back within that, again, keep us above that 90%. But I think it's important to put into perspective, we're still well above the 29-year average. This is when we continue to move up. We don't see that changing in the near term. We see that continuing to flow and again stay between that 91%, 92% as we get some of that unplanned downtime coming back. Obviously, there's planned downtime in Pad 5, and that'll keep us pretty much on a fairly stable track. Now, when you look at imports were down 305,000 barrels. That's over 1 million barrels below the 5-year average. And again, it remains. Pad 1 had an increase of 323,000. Pad 2, big drop of 382,000. That's something where we do see that bouncing. Remember, we were saying that the low end will be right at the 5-year average, and then on the top end, we're going to be making new all-time highs. Pad 3, drop of 348,000. That brings us almost 1.2 million below the 5-year average. We do expect that, again, to adjust. That lumpiness will be there, but we do expect that to come in and remain and start I shouldn't say remain elevated because it won't be elevated. It'll just be a little bit closer and close some of the gap versus what we're normally seeing. Pad 5, still that lumpiness, increase of 250,000, 248,000 above the 5-year. So we do think imports this week increase, and then you'll get that drop next week, especially because we do have spring break. We have obviously the holiday weekend, and that's going to, again, impact some of that in the near term. Here's the imports into Pad 3. You can see they made a new seasonally adjusted low. We do expect this to remain, again, kind of range bound, but move a little bit closer to the 5-year average, especially as we have Pad 3 refiners remaining elevated and trying to increase that disti cut, which means that we are going to need that heavier barrel and not so much on the lighter end, which is where the U.S. produces. Pad 2, here you can see that we normally get a drop this time of year in terms of the 5-year. We just expect, as we were saying, right around that 5-year, then the increase, and we're going to continue to see that still making highs given where heavy crude and WCS trades and where we do need that heavier crude at the moment. Now, when you look at implied demand, you can see that gasoline increased 174,000 barrels a day, went from 8.562 to 8.7. That's something that, again, we expect that to remain at about 8.9, especially as we go into next week. You have a decent pickup in driving. That's spring break. That's Easter break. So again, you're going to get that increase, but it's important to remember that we're supposed to get that increase. So the question is going to be, where are we after this? Are we going to come right back to where we were, which has been a very weak period? And we'll talk more about that in the next slide. Distillate had another drop, fell another 163,000 barrels a day. That's now 527,000 below the 5-year average a day. And the big hit is just trucking. Trucking continues to drop. We're seeing a lot of slowdowns, and that is really impacting. We did have that warm up for those that are in the Northeast. It is in the 70s. Yay! We'll finally have some warmth. It will cool down again next week. but we're just not going to see the same need for heating oil, which will help brunt some of that demand. But again, diesel demand into road fuel still remains elevated, but it's falling, and you're seeing that trucking headwinds, which again is showing up specifically in disti. Jet, an increase of 153,000 barrels a day, went to 1.6 million. As we were saying, 1.45, 1.55, right within that range. You'll get some of those spikes higher, spikes lower, but again, just right in that comfort zone. And that's something where a lot of the airports preload, and obviously the airlines preload ahead of the increase that we normally see, especially as we head into Easter, a spring break. That's the increase. Propylene dropped 442,000 barrels a day. That's 434,000 below the 5-year average. A lot of that is just driven based on shifts in heating, shifts in what we need, a little bit of a slowdown in petchem, just given some of the headwinds on the cracks. But that's something that we'll talk about more in segment three. U.S. imports of gasoline from Europe rebounded, as we were saying they would, just because gasoline from Europe is going to dump into PADD 1. So here we had an increase of about 15% to 141,000 barrels a day. And that's something that we see kind of gradually moving back up. And it normally happens on a seasonal basis, but then also just because of where prices are in Europe and the pressure in Europe in general on an economic level is going to keep that gasoline moving to the U.S. Here's where we sit when you look at what normally happens. So we're still obviously well below where we were in 2019, 2018, 2017, 2016. We're even below where we were in 2021. You can see that we typically get that spike, and the spike typically happens, when you look at 2021, it happened the same time last year. It all is going to come back to timing, because you can see with 2019 and 2018, you got that spike back up as well. Again, that's Easter, that's Passover, that's spring break. So we should get that increase. The question is going to be, where does it shake out? Because so far the data still remains concerning, and this is just another poll. Now, we try to find as many polls as possible. This is Harris. We take all the different ones to Gallup. Gas Buddy has a bunch. We try to find different ones to see, are they saying the same thing? And here, obviously, it's something similar. The new survey from Harris Poll shows 84% of Americans plan to cut back on spending as a result of higher prices. 70% of respondents said they're feeling effects of inflation, most in gas prices and groceries. So it's not surprising to see that you're going to get a cut. About over 50% are saying they're going to eat out less. Impulse purchases, that's the thing where you pick it up because it's there and you're like, do I really need this? And you put it back because the answer is 9 out of 10 times no. You'll buy it anyway sometimes just because you have the extra cash. But if you don't, obviously that becomes a bigger piece. But the driving side, we're at about 35% are going to drive less. And then flights is the one that is going to continue to grow. And we'll talk more about that in the Econ show when we look at inflation and where we see things going, as well as in segment 2 of the EIA show. So here you can see crude oil, as we were saying last week, we expected it to move continuously closer to 2018. That we don't see that changing. That's still the call. We're going to stay there. We don't see too much of a move up because remember we had a 2.5% drop in refinery run rates. We had a drop in exports. So again, that left more crude in the tanks. As run rates come back up, that's going to, again, bring us back down. So we're just going to continue to see that pretty steady move sideways. Now, when we look at days of supply, this is a bit of a lag. We will get that move back up just because we had the build of over 9 million barrels and then the drop of refinery run rates. Now, when we look at U.S. Commercial, even though we had that big build in crude, we did get a drop in products. So we're still pretty stable, and we're just going to stay very stable at this point in time, as we've been saying. Gasoline storage, you can see we're right at 2021 levels. We're still very normal. Obviously, if you take out 2021, which is kind of skewing the 5-year average, you can see that we're right in line. We're about, let's just say, 2 million barrels below normal. But again, as we get refiners ramping back up, trying to target that disti cut, we will get and still see these gasoline levels remain elevated. And here's the piece. So distillate. So normally we get kind of this flattening and then that steady increase that happens. We think it'll be something very similar, but it's just starting at a much lower level. So even if the rate of change stays this way, which is really nothing significant, we're still going to stay very far below the 29-year average, which is what we've been talking about, just to kind of blend everything together to give you an idea of just how elevated how short we are on the disti front, keeping diesel prices very high, which is what we're going to talk about in segment 2. So remember, jet can go in both. So we did get more of a recovery into the jet side. Or I should say kerosene. That's all, again, ahead of what we see in terms of airplanes, airlines that will pick back up for the holiday bump. And we did talk about that, and we'll continue to talk about that in the next segment. So when we look at the crude curve, you can see here that things remain fairly flat. We did get a bump in the front month as we did get that acceleration. I'm not really sure why we went as low as we did, but here we are, right back as we've been saying, kind of that below 100. You should probably start buying on the front month, and then as you get above 110, start to sell and just keep kind of playing that volatility. One of the things we were saying is 97 was kind of the line in the sand where we thought it could get to 97, but then get that bounce. Instead, we had a quick dip below, but again, right back. And it's just the volatility is going to remain there based on what is happening in Russia. One of the things that we've been talking about, and we'll cover it more in segment 3, Russia has no choice but to sell crude. They can't afford to shut in. And I think that's the biggest piece when you look at where the market is and the expectations is that you're going to continue to see that dumping force going into the international market. COVID still remains in place. We've had a bit of a bump in the U.S., Europe, nothing crazy in terms of where we are. Obviously, Asia Pacific still remains elevated as we continue to see some of these increases, with a lot of it being driven, obviously, by China. China lockdowns, we're going to talk way more about that in the Econ show in segment 5, but these are going to be things that we're going to have to continue to hone in on. Now, PADD 3, the bills are right in line with 2019. It's at the highest it's been for 2022. We just see this kind of staying at a fairly stable level. Again, imports are going to ramp back up, and we had a big drop, but a lot of that was just timing. So again, that's going to keep us fairly stable right within this range. We're right now at the top of the range, and we just see it staying fairly stable. Cushing, again, same thing. We're tracking essentially 2007. We just see this moving, a steady grind up, maybe a little bit of a dip, but again, just that, let's call it an average of 400 to 800,000 barrels a day. We expect to see an increase in Cushing. And then when you look at floating storage, small bounce, again, that's part of the timing delay of when do we go from floating storage directly into imports. Imports did drop. As you see the floating storage increasing, that's, again, going to just indicating that we will get a bit of a bump specifically into PADD 3 on the import side. And things are going to continue to move and be fairly fluid, especially as we continue to kind of wave in, because we do need those heavier barrels. And that's why they can't really afford to leave it in floating storage. And they're going to try to wave that in as quickly as possible. So now in the second segment, we're going to go more into the U.S. and more specifically demand, because we want to look at what is happening on the refined product front and how do we see that changing over the next few weeks.